What if I told you there's an investing approach that has historically outperformed most professional Wall Street managers, requires no individual stock research, and has historically delivered positive returns in every 20-year rolling period since 1926? It's not a secret. It's the S&P 500. Here is the 7-part masterclass on how it works. We decode complex finance into actionable wealth-building steps. If you're ready to stop speculating and start investing with discipline, hit that subscribe button and turn on notifications. Let's look at the data. Part 1. The self-cleansing mechanism. Most people think the S&P 500 is just a static list of 500 big companies. In reality, it's dynamic. Think of it like a professional sports league with a strict relegation system. To join, a company must be US-based, liquid, and profitable. But here's the key. Struggling companies get removed, and stronger ones take their place. For example, in 2025, older industrial and healthcare firms like Catalent were replaced by fast-growing companies such as Palantir and DoorDash. As an investor, you don't need to decide when to sell or buy. The index does it automatically. This process helps keep your portfolio aligned with leading businesses. Part 2. The secret sauce: market cap weighting. So how does the index decide how much of each company you own? It uses a system called market capitalization weighting. This means companies are weighted by their total value. The larger the company, the more of your money it represents. If you invest $100 into the S&P 500 today, you don't invest equally in every company. Instead, you're putting roughly $7 into NVIDIA, $6.70 into Apple, and maybe only 2 cents into a smaller company like Ralph Lauren. Why is this effective? It creates a natural momentum effect. When a company is doing well, like NVIDIA during the AI boom, its stock price rises, its market cap grows, and it automatically becomes a bigger part of your portfolio. You don't need to predict the next Amazon. As soon as Amazon becomes dominant, it automatically becomes one of your largest holdings. Part 3. The 90% failure rule. Here's the reality. The index is currently top-heavy. Data 2025, the top 10 companies, led by NVIDIA, Apple, and Microsoft, make up about 36% of the index. Historical context: in past decades, the top 10 were closer to 20%. That means about 36 to 40% of your investment is concentrated in technology companies. This has boosted returns recently, but it also concentrates risk. Diversified doesn't always mean evenly balanced. If you're finding value in this breakdown, hit that like button. It helps us reach more investors who want to avoid high fees and confusing jargon. Part 4. Active versus passive reality. Why not hire a professional manager or buy a mutual fund that promises to beat the market? Because the data says most don't. SPIVA 2024, 65% of large-cap active managers underperformed the S&P 500. 15-year trend, roughly 88 to 90% underperformed over the long term. Why do they fail? Human error, panic selling and greed. Fees. Active funds often charge 1 to 2% annually. An S&P 500 ETF like VOO charges just 0.03%. Over decades, those fees compound and may reduce your final wealth by around 40%. Part 5. The Millionaire Math: compound interest. Enough theory. Let's look at what this means for your bank account. The historical average return of the S&P 500 over the last 90 years is about 10% per year before inflation. Let's run 2 scenarios. Scenario A, the late starter. You start at age 40, investing $500 a month. At age 65, 25 years later, you've contributed $150,000. Your account balance is roughly $663,000. Your investment grew more than 4 times. Scenario B, the early bird. You start at age 25, investing the same $500 a month. At age 65, 40 years later, you've contributed $240,000. Your account balance? About $3.1 million. That is the power of the S&P 500. It turns consistent discipline into significant long-term wealth. But notice the key ingredient: time. The index is not a get-rich-quick scheme. It has historically been a reliable long-term wealth-building strategy. Part 6. How to buy it. ETF versus index fund. You can't buy the S&P 500 directly. You buy a fund that tracks it. Two main options: ETFs, exchange-traded funds, examples VOO, Vanguard, IVV, iShares, SPY, State Street. How they work? You buy them like a stock. Prices change throughout the trading day. Best for most investors. They're tax-efficient and easy to buy in brokerage apps. Index mutual funds, examples VFIAX, Vanguard, and FXAIX, Fidelity. How they work? You buy them at the end of the day. They allow automatic recurring investments such as $100 every Friday. Best for set-it-and-forget-it investors who want full automation. Expense ratios matter. VOO charges 0.03%. Some banks market S&P 500 funds with fees of 1% or more. Always review the expense ratio before investing. Part 7. The risk. The lost decade. I need to be honest, the ride is not smooth. This is where many investors quit. Data. Historically, the S&P 500 drops by at least 10% about once every year or two. It crashes 20% or more, a bear market, roughly every 5 to 7 years. Lost decade. From 2000 to 2010, the S&P 500 generated nearly zero returns due to the dot-com crash and the 2008 financial crisis. The lesson? If you need money in 2 years, don't put it in the S&P 500. This is a 10-plus year strategy. Here's the reassuring fact. Since 1926, there has never been a rolling 20-year period where the S&P 500 produced a negative return. Historically, long-term investors have avoided losses over 20-year periods. The S&P 500 is the default wealth-building tool for many investors because it replaces weaker companies with stronger ones, it has historically outperformed most professional managers, it minimizes fees that erode wealth, and it compounds small, consistent contributions into significant outcomes over time. You don't need to be a genius to build wealth. You need patience, consistency, and discipline. I'm curious to hear from you. Do you invest in the S&P 500 or do you prefer picking individual stocks? Does the heavy concentration in tech worry you or do you see it as an advantage? Drop your answers in the comments and subscribe for more educational content on personal finance. Thanks for watching.